It's not about picking stocks. It's about picking the right portfolio.
Okay, so UK, 4% inflation. I'm surprised that the pound, this is me probably being simplistic, but given that, I would not expect the pound to be bearish, because obviously there's a need to tighten further there, one would think. But
yeah, okay. This is a really good, I think this should be a really good case study. So let's put CPI on a year-over-year basis, USA versus UK. In the last, in the January period, okay? So this one goes down from 3.4 to 3.1% down, right? Oh, but it wasn't with expectations, so all the people that expected rate cuts, which didn't include us, got smoked, right? They would probably be long utilities, long TLT, right? Long AGG, which is a pretty big asset allocation for most people that trade bonds, not selling their IEF, okay? It goes down. The UK number was 4.0 versus 4.0 last month. It didn't even go down, but the expectation was 4.2. So the way the currency market traded it, and bond yields for that matter, because UK 10-year yield is actually down on that, down like 8 basis points, which is a lot, is that macro tourists still trade expectations instead of the quads. Like, because CPI is a bubble, right? It's for macro tourists. Everyone has a view on inflation. Nobody has a model, but everyone has a view. So the way Wall Street really does things is actually versus expectations, and they've always done it this way, and I don't. I understand expectations, obviously, but if the expectation for CPI being 2.9 is the number and it's 3.1, then it's higher. But the prior month was 3.4. The expectation for CPI on this side was for this thing to be 4.2, and it's 4. Like, I didn't tell these yo-yos on Wall Street to come up with this number. They're in the UK.